All right, everyone. So we are getting started with revenue recognition. And as we kind of jump into this, I think I mentioned it maybe a couple of lessons ago that I recorded where, up to this point, or maybe up until chapter 5, a lot of what we had covered, I'd call it like principles plus, things that you've seen before, maybe in a little more depth the second time. And then, last chapter when we were doing time value of money, for a lot of you, that was a fairly new concept for sure. It was, kind of a more challenging concept, and really revenue recognition is kind of another step up even from that. And so a lot of students do struggle a little bit with revenue recognition. And so to the extent that you can, I suggest you, watch these videos, before we do the lecture in class, or if you don't have me for class, watch these videos several times over, repeat things and try your best to really mentally invest in the material, because revenue recognition is a tough subject for a lot of folks. It's subjective, but there's also some technical aspects. And so this is kind of real intermediate accounting. So for that reason, I like teaching it. I think it's a fun subject. There's a lot of nuance and things to think about. And so for me, it makes it a lot of fun. All right. So, as far as the importance of revenue recognition, I mean, some could argue there are other topics that are more important, but for me, revenue recognition is either the single most, or for sure one of the most important issues in all of accounting. For one, it's for a lot of companies, it's their largest item, maybe besides total assets. But as far as like an individual account item, revenue is nearly for all companies the largest one, and so it's important. But also in addition to that, a lot of users, preparers, even auditors, there can be some confusion, and even on the part of users, sometimes there can even be some manipulation of revenue. And so that kind of creates this ambiguity where understanding the process, understanding how to evaluate it becomes really important. And so it's really a heavily scrutinized aspect of accounting. And so as a finance or accounting person, it's something you need to really understand. So what is revenue? When we use that term, what is it? And we're just going to kind of pull the definition right from the book. And so revenues are inflows or other enhancements of assets of an entity, or settlements of its liabilities, or a combination of both, from delivering or producing goods, rendering services, or other activities that constitute the entity's ongoing major or central operations. And so what are the key facets to that? Well, first of all, understand that when we think of revenue, it's really about, there's a change in the balance sheet that is sort of pushing that revenue forward. And so it could be either the inflow of assets or enhancement of existing assets. So it could be that your assets are increasing. Well, what is increasing those assets? Well, activities, services, goods that are your major central operations. If through those operations you are creating or enhancing existing assets, then that is a form of revenue. But at the same time, it's not always just that the assets are increasing. It could be a situation where those same activities are decreasing your liabilities. And so really it's the change in the net asset. So either assets are increasing, liabilities are decreasing, or both. But the key is the change in the net asset is being driven by delivering, producing goods, rendering services, or other activities that are major and central to the firm's operations. And so anytime some activity meets that definition, then we have revenue. But I want you to understand, and this is kind of going back a little bit to the conceptual framework, it's the change in the balance sheet that is driving revenue, not the other way around. It's not like you have revenue, therefore there's a change in the assets or liabilities. It's that there is a change in the assets and liabilities, therefore you have revenue. And so the direction of that is very, very important, at least theoretically. And I think conceptually, to really understand revenue, be thinking in terms of, did I create or enhance an asset, or did I get rid of a liability? And if I did, what was the reason for that? What was the economic activity behind that? All right, so now let's kind of get into the idea. So if we have this idea of what revenue is, the second piece is, okay, when do I recognize it? And we're going to be basic at this point, and then in a subsequent lecture, we'll start getting a little more into some of the nitty-gritty detail. And so what, at the core of it though, there is this principle, there's this idea that we need to kind of have always running through our minds. And so what is that? We recognize revenue when goods or services are transferred to to customers. right? So when that transfer takes place, that is when we recognize revenue. And then the amount that we recognize is basically what you expect to be entitled to. So understand, it's not the cash payment. It's not that there has to be a payment. It's that you have an expectation of receiving something in exchange for that good or service. Most of the time it's cash, but it's not the realization of it. It's the expectation. So I'm entitled to something and I expect to receive something and I can quantify that. And so now that is the amount that I assign to my revenue. And then when I recognize it is when the good or service is transferred to the customer. So those are the two aspects. So when do you recognize it and how much do you recognize it for? And so the timing is based on the transfer. The amount is based on the expectation. And so that's what we kind of have to keep in mind when we think about revenue recognition as a general principle. And we're going to get into more detail, or as I mentioned already, in a later lecture. Okay, so there are 5 steps in the process. We're going to kind of summarize them here, and then we're going to start going through each piece later on in the lecture. And so first of all, the first step, identify the contract with customers. Second step, identify the separate performance obligations. Third step, determine the transaction price. Fourth step, allocate the transaction price to the performance obligations. And then fifth step, recognize revenue when each performance obligation is satisfied. All right, so very wordy. You do need to know this for the test if you're in my class, and others, most intermediate professors will require that you're able to give us this process because it's so foundational and so core that the goal would be, at least maybe in summary, that at any given time, if someone said, hey, what are the 5 steps, that you understand that process, you have a mental map of how that process goes about. And so we talk about identifying the contract. Basically, there has to be an agreement. And again, we're going to get into the details of what constitutes an agreement, but there needs to be some agreement between you and your customer, and there needs to be some sort of obligation that you need to perform. There needs to be an action, an activity, or a transfer, or something that you need to do. And then we talk about the transaction price. There's got to be a value associated with that, some economic value. And then when if you imagine I have several performance obligations and I have the economic value, I need to assign an economic value to each of those obligations. And then as each of those obligations is satisfied, you can recognize that portion of the revenue. And so you can kind of imagine this process where you have a contract. What do I have to do in that contract? What is the value of the contract? How do I assign value? And now let's start recognizing revenue as I'm doing those performance obligations. And so that's the general 5-step process. Again, we'll get into a lot more detail in further lectures, but for now, I wanted to make sure that we kind of lay this out, know these 5 steps. You're going to be able to reproduce them on a test, and so be ready to do that. All right, so let's just kind of do a very simple example to get this idea of revenue recognition firmed up in our minds. So we sell some inventory for $23,000. How do we record this? Well, the amount. So if we talk about what do I expect to receive? Well, I got $23,000. The expectation is very, very simple because I know exactly what I received. I received $23,000. And so that's the amount. And then the timing of it is, when do I actually transfer the good? And so in this case, when I make the sale, it's an immediate transfer. And so what I want to be clear, though, is the reason that I am recording sales revenue. So the reason I'm recording that is really based on the receipt of cash. That is what drove it. So I want you to understand the fact that I increased my cash because of this economic activity. That is what drove the revenue. Now, in this particular case, we simultaneously record an expense, but our focus really is on the revenue portion of this transaction. And so the direction of the effect is really important. So again, the creation of the asset and receipt of cash is what drives the revenue. And I can very easily estimate the value of that cash because that's what I received. All right, so let's kind of talk a little bit more. My thing here, let me kind of amend this a little bit. Realize my thing's pretty small. Sorry about that. All right, so let's talk about when we recognize revenue and what it means to recognize revenue, and it's a little block there probably, at a single point in time. And so generally speaking, again, we've kind of talked about this a little bit, but as soon as my performance obligation. The question is, when do I actually complete that performance obligation? And the general rule is, again, when that good or service has transferred from the seller to the customer. So, there could be several performance obligations in any given contract. And the question is, well, when is each one satisfied? It's, well, if there's a good or service associated with that, when that transfers, that is when I recognize the revenue for that portion. And so it's really about satisfying that obligation, and that timing is when the good or service is transferred. And again, we'll get into more detail about how you can kind of, how do we know it's been transferred? And that's really, we kind of get into, this is where the judgment takes place. This is where it gets a little bit complicated, because the reality is, it's not always clear when the good has actually transferred. And so we have these indicators, and I want to be very clear. When we talk about indicators, we are not talking about rules. It's not like all 5 of these must be satisfied. That's really not the way the standard is written. The standard is written basically, hey, these are 5 indicators that suggest that the performance obligation has been complete, that the good or service has transferred. And so the first of those is that if the customer has an obligation to pay. So if I'm able to bill the customer, that is a strong indication that the good or service has transferred. In other words, I have completed my performance obligation. Another indicator is that the customer now has legal title to the asset. So if you think about, selling a car, when that title transfers over, at that point in time, the transaction has been finalized, because now the title is either in the name of a bank or, in the name of the buyer. And that indicates that the good or service has transferred. The second you sign that title, that car is yours as the customer. But from the seller's perspective, from the dealership's perspective, they want you to sign that title, because as soon as you do, it's yours. They've completed their performance obligation. Physical possession obviously is an important thing. So, if I'm physically able to do what I want with that good, or, not really a service, but, with that good or product, then that's another indication. Obviously, if I drive the car off the lot, seems like I have physical possession of the car. So it's an indication that that it's mine. But at the same time, I will say, if I'm test driving the car, nothing's happened, right? While I have physical possession, that indication is not alone, enough to allow the company to record revenue. This is kind of a more ambiguous one. The customer has assumed the risks and rewards of ownership. And so, kind of keeping with the car example, because I think it's something we can all more readily understand, is that, when you think about that car, if I'm the one that has to insure it, if I'm the one that has to fix it if it breaks, but also I get to be the one that determines where I drive it. I get to be the one that determines how long I drive it. I get to determine, if I want to take it to the beach, I can. If I want to, whatever I want to do. So risks and rewards of the car, when they transfer to the customer, then that's another indication. Again, all these things are pointing to, kind of in your mind, when you could when a dealership could recognize the revenue from the sale. But if the dealership still has to insure it, and if they can limit what the customer is doing with it, because for whatever reason, then maybe the sale really hasn't taken place. And then the final one, the customer has accepted the asset. And that's, while it's an indicator in the car example, it seems fairly clear that it's already happened. But there could be a situation where, let's say I'm shipping, it's a business to business relationship, and I've shipped something, but it's arrived, but they have not yet signed on. They have to inspect it. They have to go through a process of like, no, we are not ready to have this product yet, because we haven't done our process to see if it's satisfactory. Well, at that point, then the seller may not be able to recognize revenue, because the customer has not accepted the asset. And so you may have all these other things sort of starting to be in place, but the acceptance hasn't quite taken place. And so that may delay revenue recognition. But again, we can get into a gazillion different examples. And I'm sure in class, what ends up happening a lot of times is, a student will say, what about this? And what about this? And hopefully we have those conversations. But the reality is, for the point of this discussion, just understand there's a lot of nuance. There's a lot of detail that we'd have to navigate to get to a specific situation. And honestly, 2 people could look at the same situation and reach a different conclusion, and they might both kind of be right. And that's part of the challenge with revenue recognition, is that it's not always clear. and you could use judgment and reach a different conclusion than when somebody else might reach. All right, so kind of continuing with this. And so let's talk about a point in time versus over a period of time. And so normally speaking, what has to happen is for you to recognize a performance obligation, or sorry, to recognize revenue dealing with a performance obligation, you have to wait until that obligation is complete. And so what you really have to kind of think about, are there exceptions to this? In other words, are there situations where I can recognize revenue rather than having to wait until I'm complete? Can I recognize revenue as I'm going through the process? And for a lot of things like selling a car or selling a sweater or something like that, who cares? It's very simple. But for other things, it gets a little bit complicated. So if you had a construction project, that might take years. And so the question is, what do I have to wait to the end of 2 years to recognize revenue? Let's talk about what that might look like. If I'm doing a development contract for the Department of Defense, do I have to wait until the airplane is fielded, or can I recognize something along the way? And so all these things kind of basically are GAP allows for this exception where you don't have to wait until the end. And so the question is then, okay, what allows a company to recognize revenue over time rather than having to wait until the end? And so there's these 3 criteria. If you meet any of these 3, then you can recognize revenue over time rather than waiting until the performance obligation is complete. And so one would be that the customer consumes the benefit of the seller's work as it is being performed. And I think examples always help with this. And one of them would be something like Ernst & Young. Let's say that they have a consulting contract with Coca-Cola, and let's say that it's a 3-year consulting contract. And so they're going to help them, I don't know, do strategic planning on an ongoing basis, something like that. Well, when are they done with their performance obligation? Well, really at the end of the 3 years, if you think about it, because they're obligated, this performance obligation is ongoing for 3 years. And so I'm not really done until I'm at the end of that 3-year point. And so the question is, does Ernst & Young have to wait 3 years? And the answer really is no, they don't. And the reason why is because as Ernst & Young is providing their consulting services, Coca-Cola is consuming those consulting services. And so it does meet this criteria, and therefore they could kind of recognize revenue as they're going along rather than having to wait all the way until the end. The second criteria, if it's met, would be the customer controls the asset as it's created. Again, I think examples help. So down where I live, Blythe Construction is adding an HOV lane to 485. And I don't know if it's the city of Charlotte or the state of North Carolina. It's probably the state of North Carolina. But anyway, the question is, does Blythe have to wait for the 4-year project or 5-year project? It seems like it's been a decade, but however long it takes them to get this thing done, do they have to wait until the end before they can recognize revenue for this HOV lane project, or can they instead recognize as they go along? And really, it meets this criteria. And the reason why it meets it is because the state of North Carolina did not forfeit control of the highway while Blythe was working on it. In other words, they still controlled the road. And so because they still controlled the road, so from Blythe's perspective, state of North Carolina controls this project, controls this road that I'm working on, or this lane that I'm improving. If anytime they can just say, we're done, and we're done. They have control. Since they have control, I can recognize revenue as Blythe Construction as I'm going along, rather than having to wait until the end. And then the third criteria is if the seller is creating an asset that has no alternative use to the seller. So I'm the seller, I'm creating an asset, and I can't do anything else with it. And for what I've done, I have a legal right to receive payment. Again, I think an example of this helps because this is a classic one. So let's say that Lockheed Martin is developing a radar system for the F-35. Well, it's not like Lockheed Martin could develop this radar system and then decide, oh, you know what? I'm going to go sell this to Boeing. I mean, that's not really how it works. They're not allowed to do that. The government's going to control that. And so they have no alternative use for any of this research and development that they're doing for this radar system. And at the same time, most of the time in this kind of arrangement, Lockheed Martin is able to collect for the work that they've done to date. In other words, if the government cut the project off Well, Lockheed Martin could say, well, here's the work that we did. You need to pay us for what we did. And so it meets that criteria. And so in that case, Lockheed Martin would not have to wait until the whole radar system is fielded and done. They could recognize it as they're going along, as they're developing that radar system. So again, these criteria, if they are met, if any one of them is met, that allows the seller to recognize revenue as they're going along, rather than waiting all the way until the end. So it allows them to accelerate revenue recognition rather than delaying it until the end. All right, so whenever you're able to do this, recognize over time, there has to be a way to measure progress. In other words, if it's a $50 million contract, how much do I recognize, after the first month, second month, third month, how do I go about doing this? And really there's two general approaches, and we're going to get into more details of this, later in a different lecture, but either it's input based or it's output based. And so you can say, well, how many hours am I putting into the project? That would be more of an input based kind of thing, or how much cost have I incurred on the project? That'd be more input based. Output based may be more like, okay, if I'm laying a road, how many miles have I completed, or what, something along those lines. And so that's more of an output based view. And so again, input versus output, GAP allows for both, sort of general methods, and we're going to get into one, which is an input based method in a greater detail in a different lecture. All right, so when we have the question is, how do I know if I have one performance obligation or if I have multiple performance obligations? How do I make this distinction? Again, we're trying to get core concepts out of the way. So if you have distinct performance obligations, then it could affect the timing of revenue recognition. So in other words, if the entire project is one massive performance obligation, well, everything kind of gets jumbled up into that one. But if I have distinct performance obligations, as I recognize each one, I would recognize revenue for that portion. And so it can kind of change the timing of revenue recognition depending on whether you view everything as one performance obligation or whether you think they are distinct. And so how do I know if they're distinct? And so that's really, because a lot of companies would prefer distinct performance obligations because, again, it allows them to accelerate revenue recognition. So it has to meet both of the criteria. First of all, it has to be, capable of being distinct. And the way we kind of think about that is could I obtain, in other words, if let's say that I say, I have service A and service B, and I want to treat them as distinct. Can they be distinct? In other words, could company A do the first performance obligation, and then could company B do the second one? In other words, are they distinct? Or by doing A, must you also do B? It's sort of like one of those things like, okay, are they both required to be bundled together, or could I actually distinguish these different items? So, something like a software system, sometimes it can be difficult because, what if you're installing software and then you are doing upgrades to that software? Well, could one company install the software and another upgrade? Probably. I think in a lot of cases that probably could happen, but maybe not always. Maybe there's something inherent to both. I don't know. I'm not an expert on software, but I'm trying to think of, this idea of certain times they aren't distinct. So another example, again, if there's a complicated product where part of the product cannot be operated with the other one. I can't sell, I don't know, can I sell a car without a key or without an engine? Well, no, because you can't have that done by two different companies. So again, these examples, sometimes it's hard to come up with them. The whole idea is, can these different performance obligations truly be distinct or not? And if they are, then it's a case can be made that they are distinct performance obligations. And then second of all, are they identifiable in the contract? That's so in other words, are they capable of being distinct? And then are they identifiable in the contract? And so, a key feature there is there like an individual obligation, or are they kind of holistic? And I think an example does help with this particular, especially this second one. let's talk about a contractor when they buy building materials. They need to buy lumber, they need to buy, concrete, they need to buy nails, they need to buy, drywall. Think about the electrical. All these things go into a house, and so when a contractor goes and they buy lumber, that is distinct from buying nails. In other words, I could buy lumber from Lowe's and I could buy nails from somebody else. And let's say that I have the entire contract. Let's say I have a building supplier, right? Likely it's the case that the lumber is one item and the nails are a different item with my contract with that building supply company. And so for a contractor, thinking about the person selling the contractor those materials, they can recognize the lumber when they sell the lumber, and they can recognize the nails when they sell the nails. I mean, they're distinct, they're capable of being distinct, they're likely distinct in any kind of contract that they have. Somebody else could do the nails and somebody else could do the lumber. And so you think about that. So from the building supplier's perspective, those items are distinct, and I could recognize revenue because each of them is a distinct performance obligation. Now, the builder has a different situation when it comes to the customer that they are selling the house to. In other words, I can't distinguish the lumber from the nails for my resident that wants to buy the house that I'm building. There's no distinction there. Now, could one company supply the lumber and a different builder supply the nails? Yes. So we meet the first one. I guess they're capable of being distinct. But the second one really isn't. In other words, it's not like it's not like with the customer, like, hey, listen, I'm going to build your house, but I'm going to be very clear. While I'm building your house, really what I'm doing is I'm giving you lumber, and then I'm giving you nails, and then I'm going to nail the lumber together in some form. And then that's not the contract. The contract is build me a house. And so in that case, they probably could not recognize revenue as a builder for the fact that they now have lumber on site. Like, they can't really recognize revenue for that as far as a distinct performance obligation. And so again, these details, it does get a little bit nitty gritty because it might not seem like a big deal building one house, but if you're building a million houses, being able to recognize revenue for lumber as a builder, maybe you could accelerate a large portion of your revenue by doing that. But GAAP would say, no, you can't do that because the lumber is not distinct from the house. And so again, that's just sort of one example, and I'm sure in-class will have a million others. Let's just kind of walk through a quick example. So a company has software and help desk service. We're going to assume in this case that if I provide the software, somebody else conceivably could provide the service. Let's say it's software like Microsoft or something like that. And so you've seen these journal entries before. I am not trying to beat you up with this, but let's kind of walk through just generally how this would look. And so if we make this sale, the customer owes me $15,000 for the sale. A portion of that is allocated to the software, $11,400. The rest is allocated to help desk service, but the key is the software has been delivered, that performance obligation is done, but I have not yet provided the service. And so there is this element of deferred revenue. If you remember all the way back to chapter 2, deferred revenue is a liability. And so really my revenue here, this $11,400, the reason I'm able to recognize $11,400 is because of this AR, $15,000 in AR, $11,400 was for a good or service where I've already completed the performance obligation. So I have the software, I have the asset that's been created, and the question is, have I actually performed the service? Well, I've performed the service for the software, so I can recognize that piece, but I have not performed the service for the help desk, and so I have to wait. I have to defer that revenue, which is why we have that liability. Then as time goes on, let's kind of think about what happens at the end of the month. First of all, I do collect. It says that I collect $1,250 every single month. And so at the end of the month, of course, a portion of my receivable goes away in the amount of $1,250. Notice, though, this did not change anything in terms of revenue recognition. It's just a collection of a receivable. But part of my revenue recognition did change in that, something like help desk service, that's something I can recognize over time, for those three criteria. If you kind of go back to that, first of all, they control it and all that kind of stuff. But I can recognize, 1/12 of it. And so the full, I think it's, yeah. So is it 1 year? Yeah, 1/12. And so I can recognize 1/12 after a month because now I've performed a portion of that performance obligation. I can measure that as 1/12, and so I can recognize $300. But notice then this service revenue is being driven by the expiration of a liability. So originally I had an obligation to provide 12 months of help desk service. After 1 month, my obligation isn't 12 months anymore, it's 11 months. And so my liability has gone down. Because my liability has gone down, I can now recognize revenue because of the reduction of that liability. Let's post these real quick. Again, just kind of refreshing ourselves on T accounts. And so on the AR side, of course, this initial transaction, we're going to debit receivables and we're going to credit deferred revenue as a liability, and we're going to credit sales revenue as a liability or as a revenue account. And then the second piece then is on the 31st. We're not going to worry about the cash, but the receivable amount is going down because we've now received partial payment. Our deferred revenue has now changed, which is right here, because a portion of that deferred revenue is now recognized. And so again, here's the second piece. And then finally, related to the expiration of that liability, we can recognize some service revenue. And so at the end of the month, we have these updated balances where receivables now reflect 11 months or whatever I forget the length of time. I think it's 11 months of payments. And then our deferred revenue reflects 11 additional months of providing help desk service. And of course, now we have service revenue that we did not have before. All right, so this is the first one. We're going to kind of stop here, and then we'll kind of pick up the next one. This is kind of a longer introduction. Hopefully it's helpful, and we're kind of on our way with revenue recognition.